All right, my friends, be very, very careful of inverse or leverage ETFs. I'm telling you, man, I'm getting emails about this, and this concerns me deeply. So let's dive right into it. We're looking at my normal Seeking Alpha Wall Street breakfast. They talk about Roe v. Wade, which I hope it does get overturned. That's fantastic. They talk about don't say gay pill. They say Amazon is going to pay, birthing persons to have abortions. So they have to go out of state and whatnot. It's crazy. They shouldn't be getting involved in that, but whatever. I'm okay with Roe v. Wade gets this overturned. If that bothers you, I'm not the channel for you. Obviously, you're new here, and that's okay. It's a state thing. It always should be a state thing. It was legislated incorrectly. It actually wasn't legislated. It wasn't legislated at all. It was dictated by on high by a stupid Supreme Court coming up with a privacy option. Stupid. Anyway, so I hope that comes to fruition. All right, so I want to go into this real quick. This is the FOMC, the Federal Open Market Committee. It convenes today for its May meeting. Expectations are on a 50 basis point hike tomorrow. Investors will be carefully parsing the language of the statement for any changes outlook. The dip in Q1 GDP won't likely prompt the Fed to ease off the gas. So no, because we got to show people we mean business. And when we mean business because the Fed has control. No, they don't. They have no control. They can buy, they can sell their bonds back to the banks and take that cash back and reduce liquidity and increase the interest rates as well. That's literally what they can do. And that's what everyone says, that's going to whip inflation now, just like Volcker did. We know that was a scam. Volcker didn't whip inflation now. But anyway, that's the whole point. Raise interest rates, reduce liquidity, and that will stop this incredible inflation. And then I just always point back to, velocity. Banks can be sitting on a freaking Fort Knox of ones and zeros called cash in their vault, an electronic vault. If it's not getting out in the economy, it doesn't mean squat, man. Just people. It's Japan. It's the Japanese recession, the balance sheet recession. Banks will desperately loan you money, but people, I don't want your money. Now the interest rates are higher. People will be borrowing money less, which means it doesn't get out of the economy, and the velocity of money is the lowest we've ever seen. It's insane, man. It's going to continue like that. Anyway. All right, so anyway, what happens here is we got strategies. While rising yields have crushed treasury-related ETFs, 10% ain't crushed, but whatever, there are ways investors can exploit a rising rate environment. They can buy inverse ETFs that are designed to bet against bond prices. For examples, and year-to-date prices include these guys. So we're going to look at this one right here, TMV, which is 3 times the shares of the 20-year Treasury Bear. All right, so basically if the 20-year Treasury Bear goes up, the price, the TMV goes down, and vice versa. It's a seesaw. So we're going to go over here to Schwab, and we're going to look at TMV. And we're going to say, holy crap, holy. Whoa! TMV is down 54% over the last 5 years. Look at that. Is that about $225, and now it's trading at $98. And that's at 54%, including a 67% performance year to date. Jeez. Oh, yeah. Look at that. Woo! Nelly. You got 52 cents, 6 cents, 52, 55, 43, 70, 55, 21, 20. And you haven't got any more at all right there. I don't know what that L is. I guess that's the lowest, 43.85. So the lowest was 43.85. So it went from 250 to 43.85, and that was in July of 2021, I guess. Look at that. That's freaking nuts, dude. So now you've gained back quite a bit over this last year, but you're not anywhere near to breaking even. Anyway, so the point being is a lot of people don't understand how these works. They have not paid a regular dividend over the past 12 months. Yeah, shocking that. All right, leverage and inverse ETFs are not what you think. I remember reading this article, or an article similar to this from ETF.com many years ago. And I'm not sure when this is written. It might be the same one I had read. I read this article like this a long time ago, and I said, man, I did not know that. All right, leverage or inverse ETFs deliver the desired returns over pre-specified periods only, usually one day. By desired returns, we mean the stated multiple, 2 times or 1 time or 3 times, of the fund's underlying index. That is, an ETF that offers 2 times the exposure to the S&P 500 only attempts to do so over each one-day holding period. Investors can hold the ETF for longer than the day, but returns can vary significantly from 2 times exposure over longer periods. That's because the ETF resets its leverage daily. In oscillating markets, the leverage reset can significantly erode returns. A lot. The math of resetting can be confusing, but the concept is one that's well known: compounding. Every day the fund earns a return, either positive or negative. And it must reset its exposure to constant multiple to changing asset base. All right, so here we go. We have a negative 2 ETF. The index is at 100, we're at 100. All right, so we're at negative 2. So the index the next day goes up 10%. Ooh, we're 2 times leverage. So that means we're down 20% because it's up 10, we're down 20, if that makes sense. So now the index went to 110, we're down to 80. No dividends, by the way. And now the next day, the index is down to 10%, so we are up 20. But remember, losses hurt more than returns, than gains. Because we're now up 20, but we're up 20 off an $80 base as opposed to up 20 off a $100 base, we're only getting 16 bucks back because of compounding. And as such, we're at 99 bucks. Yet if we would have just held the index naked, we'd be at $99. Now, if you do that every day, we know that the markets generally, this is the stock markets, but bonds even more. They go up a hell of a lot more than they go down. They just do. It's like the roulette wheel, man. On day 1, the 2 times index fund's at 100. On day 2, the index goes up 10% to 110, and then the fund falls 20 to 80. So far, so good. But on day 3, the index falls 10%, and which is down to 20% of 80 is 16, so it goes from to 96. The example shows the fund doing exactly what it promises, giving you 2 times leverage. However, that 2 times leverage says we've actually lost money, even though we're up 10 one day and down 20 the next day. The returns on the downside are hurt more than the returns on the up. That's just all there is to it. Do be clear, if you're making a short-term bet on something, speculating in other words, you may not care about achieving the precise 2 times. However, you're trying to hedge interest rate risk or currency exposure in a portfolio context, you simply must monitor and rebalance your exposure for anything but the shortest time frame. Techniques for rebalancing include time-based and trigger-based. Oh, it just bores me. Rebalancing means buying or selling the inverse ETF to realign with the desired multiple, 100%. So I want to show you guys something here. If we go back to this guy right here. Now, why is this thing up so much? And especially since March. Look here, man. It was at, let's see, March. What's it? That's January. It's February. There's March. That's when the Federal Reserve FOMC was meeting. And that was, it's like at 60 right there. I wonder if I can just do 3 months. Yeah, there it is. Right there, March. So basically from March, when they met at 60, it's gone up to 98. So it's gone up, you know, I mean, the whole game, 60 divided by 38 divided by 60. It's gone up. Basically, the whole return has been since March, man. The entirety of the return of this year has been since March. That's it. Why? Because just what Wall Street Seeking Alpha said, expectations are already priced in at a 50 basis point hike. It's already there. If you think that if they raise the rates tomorrow that all of a sudden these bonds are going to fall off a cliff, I don't know what to tell you, man. It's already there. Or like, oh my goodness, I should inverse it because then the bonds will go down and I'll have an inverse ETF. I just think it's crazy. Inverse leverage is, I'm telling you, man, leverage has put a lot of people in a bad place. I'd be very, very careful. All right, love to hear your thoughts. So we'll see you.